Oil. It used to be the most important resource in the world. As the driver of the Industrial Revolution, securing supply was of utmost importance and the cause of multiple wars. But the industry was mostly forgotten the last 2 decades, with oil being abundant, prices at historic lows and profits close to non-existent. Instead, fast-growing tech companies took the main stage and the oil industry faded away into obscurity. Through a combination of aggressive investments into renewables, a political stance of stopping oil extraction at all costs, and a pandemic crashing demand, more and more oil plants shut down, resulting in a massive supply crash. Everything leading up to a whiplash effect seldom seen in the commodities markets as the COVID lockdowns stopped, with the result being massive inflation. Don't let the politicians and news outlets fool you. It's not the result of excessive money printing, but of broken energy policies worldwide. The seeds were planted already back in 2008. Instead of letting the downturn run its course, the Fed intervened heavily and started manipulating the market, lowering interest rates to record low levels, bailing out speculators from bad debt, and pumping in money through quantitative easing. Having taken lessons from the seeming success of Japan spurring its return to growth in the early 2000s, the Fed's actions created the longest bull market in history. This bull market yielded a massive 700% gain over 10 years. But the big thing to look at are the interest rates. It's not just the US with low rates. As interest rates are a big factor in determining exchange rates, it became a race to the bottom and the rest of the world were forced to lower rates as well. The 20-year period of record low interest rates and QE by the Fed and the world's national banks to try to boost inflation only led to a historic misallocation of capital. Surely you are aware of what I mean by misallocation of capital: assets, products and startups that produce zero value. In fact, they might be net negatives. Still, they have gotten hundreds of billions in investments the past years. Peloton, peak market cap $46 billion. They sold exercise bikes with iPads attached. Somehow lost $2 billion from $4 billion in revenues. Uber, peak market cap $112 billion. Lost between 4 to 8 billion a year, and they don't even buy taxis. Bitcoin, peak market cap $1.16 trillion, produces no value to its owners, uses 150 terawatt hours of electricity a year, more than the entirety of Argentina. This is what happens when interest rates hit zero. As bonds no longer provide returns for retirement and other savings, the stock market gets flooded with capital, causing stocks to always go up, no matter the underlying business concept or financials. In the exuberance, people jump in with their life savings into companies they know nothing about and they have no plans of ever being profitable, cannot be profitable, and will not be profitable. But the stocks keep going up. It becomes a game of biggest loser or biggest fool. These people are about to lose it all, if they have not already. So there is misallocation of capital for 2 decades, and then a once-in-a-century event hits, COVID-19, with 2 big results. The Fed pumping an insane amount of money into the economy, the US government giving away very beneficial loans, and demand for fuel collapsing seemingly overnight. The Fed giving away so much capital made the stock market increase to never seen before heights and exuberance. The S&P 500 rallied 80% in a year and a half, the Nasdaq over 100%, IPOs were at an all-time high and an all-time expensive. Tesla, a barely profitable company, was valued at $1 trillion, all fueled by free capital. But something has to give. it is not sustainable. What initially became obvious is the deterioration of the supply chains. An increase in e-commerce volume caused big supply chain issues. Hundreds of ships stuck in lines outside harbors, shipping containers running out, shipping times increasing from days to weeks. The next big systematic breakdown, the fall of oil prices subsequent to the lockdowns, caused hundreds of drilling sites to go offline permanently. But the world would inevitably open back up, normal life would resume, and with it demand would mostly normalize. Supply certainly showed to not be as elastic. Restarting an oil drilling site requires millions of invested capital. In a world that has taken a sharp turn against non-renewables, with talks of banning them and politicians cancelling drilling permits seemingly at the whim, that is not an investment anyone wants to make. And there you have the scenes set for a massive energy shortage with sharply increased prices across the board, economic pain, and most importantly, inflation going to the moon. The Fed tries to fight the inflation caused by this with the two tools they have at their disposal: increasing interest rates and quantitative tightening. They hope this will reduce demand, alleviating the supply-demand imbalance, but a big danger lurks. Both their tools make capital more expensive and reduce access to it. So this might very well also reduce the already low investment into commodity extraction. Oil and gas are industries that are hopefully going away in a couple of decades. More expensive capital makes you require a higher return on your investment. Would you really invest here, knowing it very likely might be outlawed? Or at least that you will have every single lawmaker against you? So unless the Fed hike the rates so much we enter a recession, energy demand will probably not decrease significantly, and we're stuck with high inflation. People still need to heat their homes and eat food. We are about to enter a decade of stagflation, economic contraction, and high inflation, just like Japan has been for the past 30 years.
The end of capitalism. This is like the Dark Ages all over again.
The uncomfortable truth is that the Fed's actions might make the situation worse. Any solution is going to be political. Massive investments directly into oil and gas to incentivize more extraction, which is clearly politically untenable. Is this a policy the world would support? We are stuck between a historic recession and stagflation. Until the world realizes a radical shift in policy is needed, or the investment into oil and gas catches up with demand. The good thing is, economic growth should ensue eventually, although it might take a decade for the required investments into oil and gas to trickle in and come into effect.